Are SPACs good for newcomers? What's that? Another complex acronym. Oh God, it seems like those people from Wall Street are doing nothing other than inventing new terms and concepts. But wait, this new thing has already raised more than 100 billions in 2021. Maybe it was worth being invented after all. Let's take a closer look at SPACs and find out if there is something worth our money. Things that you need to know about SPACs. First of all, let's find out what SPACs are. Unwrapping the acronym won't give us much. SPAC stands for a Special Purpose Acquisition Company. So how about we look at what they do? Those companies are non-operating, meaning that they don't manage any assets or conduct an actual business. Another word for them is blank check companies. They collect money from investors, and after that, they start to look for a private company to purchase and place on the stock market. Sounds unusual. A company can participate in an initial public offering on its own. Why complicate things? However, there are a few reasons to do things this way. Imagine you are an owner of a promising company that wants to go public and raise some money for future development. To do this, you have to call for an IPO and sell shares to investors. But what if your company is too small and young at the moment, or you just don't want to spend a lot of money and time on an IPO? That's where the SPACs come into play. They allow private companies to become public without an actual IPO. How is it possible? SPACs go through the IPO process before they even choose which company to acquire. So later, when they find an appropriate business willing to go public, they just merge with it and change the ticker. Considering all this, every SPACs go through a few obligatory steps. A sponsor creates SPAC by investing some funds and setting a managing board. SPAC goes through the IPO process and becomes listed on the exchange. That's where investors step in. SPAC's managing team starts screening the market for possible acquisition targets. This step includes the negotiations with selected companies as well as due diligence and audit. After this point, we can have at least two options. If SPAC didn't find an appropriate company in 12 to 18 months from IPO, it would dissolve and give investors their money back. If the suitable company was found and approved by SPAC shareholders, the merger would take place and SPAC would be replaced by this new player on the public market. What's here for investors? One of the most attractive things about SPACs is that in case of the whole project failure, investors will just get the money back. What else makes SPACs so appealing that people are rushing to put their funds in? It's the possibility of getting something valuable for a relatively small price. When SPAC is going public, it offers investor units, priced typically at about $10 per unit. A SPAC unit contains one common stock plus a warrant or a fraction of a warrant. In the second case, to get a whole warrant, you'll need to buy a few units. After the merger, your SPAC stocks become stocks of the acquired company. Meanwhile, the warrant lets you buy more stocks for a specified, and also quite low, price. Looks like a good deal, especially for somebody new to the stock market. If the chosen company performs well, you can get a lot more than those $10 you've invested at the SPAC's IPO. Just take a look at DraftKings or Virgin Galactic, whose stocks went from $10 up to about $50. And if SPAC doesn't find a company to merge with, your money is not gone, you get it back. Win-win situation. But there are a lot of buts with this investing trend, and we are going to find why you should think twice before giving your funds to SPAC. What to be aware of? SPACs are a pig in a poke. When you are buying a SPAC unit, you never know what would be the actual company you are investing in. Some crazy startup that will die in a year, or a good performing business that will bring you a fortune. It's supposed that SPAC's management would do their job and check and recheck every detail of the selected company. But that's not always the case, and the human factor might play a bad joke. SPAC's main advantage is not really an advantage. Yes, you'll get your money back if SPAC doesn't find a company to merge with. But a chance to place our money somewhere and just take it back in 2 years is probably not the investment of your dreams. SPAC safety is an illusion. What if a merge was successful, but the choice of a company was poor and the stocks went down after the ticker change? You can still lose your money. Numbers are against SPACs. There are some that performed very well, but most of the SPACs didn't find a company to merge with and therefore failed. And what about those that did? About 60% of successful SPACs are not catching with S&P 500 index, and about 40% of them are trading below their starting price. As you can see, SPACs are definitely not the best investment choice unless you are a SPAC manager who gets his profit in any case. You can take the risk, of course, and if you are lucky you can multiply your money. But make sure you know all the pitfalls of the SPACs. And good luck to you whatever you choose. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about the SPACs in the comments below. Thanks for watching and don't forget to subscribe so you don't miss any of our new videos.